Welcome back to the channel, everyone. Today, we're diving into a topic that many of you have been curious about: the comparison between exchange-traded funds, or ETFs, and mutual funds. Both investment vehicles are popular among investors looking to diversify their portfolios, but they come with distinct features that can significantly impact your investment journey. So, let's take a closer look at these two options and help you reflect on which might be the better fit for your financial goals. Let's start with liquidity. One of the standout features of ETFs is their ability to be traded throughout the day on stock exchanges, similar to individual stocks. This means you can buy and sell shares of an ETF at any time during market hours at the current market price. This intraday trading can provide investors with greater flexibility and responsiveness to market changes. On the other hand, mutual funds are traded only once per day after the market closes. This means that any orders you place during the day will execute at the closing price, which can sometimes lead to missed opportunities if you're trying to capitalize on market movements. Now, let's discuss accessibility. ETFs tend to have lower minimum investment requirements compared to mutual funds, making them more accessible for novice investors or those with limited capital. Many ETFs can be purchased for the price of a single share, while some mutual funds require a minimum initial investment that could range from a few hundred to several $1,000s. Additionally, ETFs can be purchased through most brokerage accounts without having to go through a financial advisor, whereas mutual funds may require working with brokers or platforms that offer them. Profitability is another essential factor to consider. Historically, both ETFs and mutual funds have provided solid returns over the long term. But there are nuances in how they achieve this. ETFs typically have lower expense ratios compared to mutual funds because they are usually passively managed and track an index rather than employing active management strategies. Lower costs can lead to higher net returns for investors over time. However, actively managed mutual funds aim to outperform benchmarks by employing professional managers who make investment decisions based on research and analysis. While this can lead to higher fees, it also presents the potential for higher returns if the managers succeed. When we talk about risk, it's crucial to recognize that both ETFs and mutual funds come with their own sets of risks. The volatility associated with ETFs can be higher due to their intraday trading nature. Rapid buy and sell orders can lead to price fluctuations throughout the day. Conversely, mutual funds might provide a smoother ride due to their daily pricing model. But investors should also consider the risk associated with actively managed funds underperforming their benchmarks over time. Next up is a psychological factor that often gets overlooked: investor behavior. The ease of buying and selling ETFs might encourage more frequent trading, potentially leading to emotional decision-making during market swings. This could result in buying high and selling low, an investor's worst nightmare. Meanwhile, mutual fund investors often adopt a buy-and-hold strategy given their longer-term approach. However, they might also feel more disconnected from daily market movements since they don't see their investment fluctuate throughout the day. Another point worth mentioning is tax efficiency. Generally speaking, ETFs are more tax efficient than mutual funds because of how they are structured. When you sell shares of an ETF in a taxable account, you only pay capital gains taxes on your profits, not on unrealized gains within the fund itself. Mutual funds can generate capital gains distributions when the fund manager sells underlying securities for profit within the fund, which may trigger a tax liability for shareholders even if they haven't sold their shares. Now that we've explored various aspects of both ETFs and mutual funds, liquidity, accessibility, profitability, risk considerations, psychological factors, and tax efficiency, it's essential to reflect on what aligns best with your investing philosophy and financial goals. In conclusion, both ETFs and mutual funds have their unique strengths and weaknesses that cater to different types of investors. The decision ultimately boils down to what fits your individual needs better, be it liquidity for quick trades or actively managed strategies for potentially higher returns. I invite you all to share your thoughts in the comments section below. Are you leaning towards one option over the other? Perhaps you have experiences or insights regarding either investment vehicle? Your engagement helps create a community where we can learn from each other as we navigate our financial journeys together. Thank you for tuning in today. Don't forget to like this video if you found it helpful and subscribe for more insights into personal finance and investing strategies. See you in the next video.